Hello, everybody. We are back. I'm Tom Sosnoff. I'm here with Dylan Radigan. Dylan, how are you?
I'm good. I got a sort of time travel experiment that I want to do with you today, if I could. Are you feeling?
I'm fired up. I'm ready to go. All fired up, ready to go.
I want you to close your eyes, at least metaphorically, and imagine you are traveling through time and space, through the intergalactic, through the Milky Way, through the universe, through the solar system, through the other galaxies, and you end up in Greenwich, Connecticut.
Okay. Been there many times.
And once you get there, you find yourself flipping through first the general hedge fund holdings, like whatever the top 10, whatever hedge funds are. I won't drop names, but everybody knows the big hedge fund names and whatever. And you're flipping through, because everybody's got a different angle. They're all like, oh, I'm a super macro. The other one's like super technical, and the other one's, everybody's got their thing, right? Whatever it is, and it's a big song and dance, and they're marketing, and that's why you got to pay them. And
Yeah.
So we're flipping through all. And we look at the top 10, they all get different angle, different strategy. But when you look at what they own, they all end up owning basically the same stocks.
Yeah.
Apple, Tesla, Amazon, Meta, whole ton of NVIDIA these days, God help you. Maybe a little Visa, a little payment processing angle, throw that in there. How is it that the so-called smartest minds on earth, each with their own unique, super proprietary, Paul Tudor Jones, Stevie Covey, all the most famous and wealthiest names in the history of finance, the big swinging dicks, I believe they call them in times of yore. Why do they all own the same stocks? And why are they the same stocks that like anybody would own after all the ego and fee?
Well, there's a couple reasons. The first reason is that the fact that they all own the same stuff may be more of a testament to their ability to not try to differentiate themselves from the rest of the crowd, because they realize the large hedge fund guys are just their own version of an index fund, and they don't care if they outperform. They don't care if they outperform the market. They care if they outperform their peers. And so,
or they care. They care that they don't underperform.
They don't.
All
right, they don't underperform their peers. Better said. So their market, their benchmark, is the group that they hang around with. And remember, the old adage that, you're really just the average of all the people you hang out with. And even though these guys are not all friends, in fact, they probably all hate each other, they are the people they hang out with. And so their ability to maintain the exact same positions is really kind of funny.
It's borderline.
But it's not. But it's not. I'll tell you why it's not shocking. Because like when we're on the trading floor trading, every trader has the same positions on, and nobody likes each other.
You mean back in the day when you were together?
Back in the day. But even the people you don't like, the people you hate, we all have the same positions on. You like person, hate the person, whatever it is. Everybody ends up with the same positions on, no matter what. And everywhere in the world, no matter what it is, whether you're an art dealer, whether you're a real estate, mogul, whatever it is, everybody ends up.
You're an automotive designer in Germany,
whatever it is,
same car.
You all end up with the same inventory because because that's just the nature of the business. Even private equity, when you think about it, private equity, they all have basically the same portfolio. That's why they all do the same deals.
Auto parts, packaging, and materials.
No, but they all have the same. They're all invested in the same companies. Like that's like when Andreessen's the lead, everybody else is in. When Sequoia's the lead, everybody else is in right behind them. That's the whole thing.
KKR, TPG, it never
SoftBank,
ends.
The whole deal. Very difficult to stand alone. The only person that comes to mind that's a little bit outside of this kind of, would be like the Warren Buffetts of the world that are like, they're still in their mirrored in their old school, kind of value, like investing, that kind of thing. I would put them a little bit outside of these other groups.
Like even a Carl Icahn is an iconoclast.
Yeah, I think Carl Icahn's a little different too, but for the most part, all these guys are the same, and they just don't want to underperform one another. And of course, individual investors can do it, but these guys get paid to take massive positions, and that's the difference. It's just scale,
So basically, because I can go, anybody can go, literally anybody can go.
If you ever talk to one of these guys, they're not that smart. They're no smarter.
No, I have talked to them.
They're no smarter than you, me, the bat.
But the smart. But I mean, here's where I take issue. Here's where they are for sure smarter than me and a lot of other people. Is they're much more effective at persuading pension fund managers that they have some sort of magic dust. Because again, I don't have the ability to persuade the New York State Pension or CalPERS or TIAA Cref.
Well, they're salespeople.
To stake me $10 billion that I can then use to buy Apple and Tesla and Visa and Nvidia.
Yep.
I mean, that's the real distinction.
Well, it's a good sales process, and sometimes money chases money, and it's they've learned.
But I think it goes further. I'm not to interrupt you, but I think this is an interesting. I just thought of this, but it's not just that the hedge fund managers own the same stocks, or the traders have the same position, or the car designers make the same car, but the pension managers don't want to get fired for being a bad pension manager. And the difference, if they give Dylan Ratigan $10 billion, financial journalist, financial commentator with no track record and no history with $10 billion, and if they give it to somebody in Greenwich, is if someone in Greenwich loses the money, they can say, well, listen, Texas pension gave them the money and Florida pension gave them, everybody was giving them the money. Like, in other words, there's even safety for it goes beyond the hedge fund manager and the private equity manager. And the trader.
How do you think FTX raised all their money?
Right.
SoftBank was in, Sequoia was in, then everybody else just piled in because it's the same exact thing. Why do you think the New York Teachers Pension Association invests in FTX or whatever it is? It's only because
the Illinois whatever nursing pension or whatever it is, it never ends.
Yeah. I made an investment once because I said, I didn't really want to do the due diligence. So I said, who invested in this company? And they gave me two names one was Mark Cuban, and another name was some other guy in Chicago who I really respect. And so I go, fine, I'll be in. Just because those guys were in.
Yeah. And that's a brilliant thing if you're the founder, is you can find one Tom Sosnoff.
I know. And
then
the reality,
Tom Sosnoff's doing it, and then neither one is doing it, but you tell the other one that the other one is doing it, and then they both do it.
Yeah, somebody was. There was a young trader who was raising money for a prop firm, and he's like, Tom, I really need you because if you come in, then everybody will follow. And but I like the kid, so I came in, and everybody followed. So I mean, it happens. I didn't talk to a single person, so I didn't. I'm like, I just do my own thing, but whatever.
No, but it's implied by your.
I understand. I got it. I clearly understand.
But so the only thing that it's more exciting than everybody doing the same thing together is when somebody famous says that they're all wrong. That people really love, right?
Sure.
And I'm thinking right now about Michael Burry and obviously his celebrity position from The Big Short, which arguably is just a luck of that, probably a coin toss at the end of the day over time.
He's no different. He's no different than any other coin tossers, from Joseph Granville on down to throughout the years. Elaine Garzarelli, of course. Everybody, to what's her face, the new one.
Ark, whatever her name is.
Yeah, Ark Investments to
Kathy Ark.
Yeah, Kathy Woods. But to everybody else throughout the, someday somebody's going to wake up and utter the words that were said to me that changed my life, which is, it wasn't crap, it was F. I don't give an F what you think the market's going to do. You don't know anything. And ever since this one trader...
That's kind of where I'm going with this, right?
Yeah, of course. Ever since that one trader told me that 30, 40 years ago, I've never listened to one person ever.
And yet, huge amounts of money end up in the custody in Greenwich, and they end up in the same stocks.
Sure, of course.
Huge.
It's human nature. Come on, man. We're all.
But at the same time, how can anybody with a 1/10 of a brain has to understand that no one knows?
That's not even remotely true.
So you believe to this day, despite all the data,
yes,
there's still the belief that someone knows, and that maybe this guy in Greenwich or this gal in Greenwich knows.
I think that the majority of people everywhere think someone knows. I think not only is it like, do most people realize that nobody knows? I think that it's like 90-10. People believe that somebody knows something.
But 90% of people that are in the market, if 9 out of 10 people, if you said, do you think there's someone who knows? They'd say, yeah, for sure someone knows.
I think 90% of people believe. It's not, they believe in everything. They believe in like some.
But do they believe that they know, or do they believe that the sheik knows, that the Alibaba knows? Do they think that they know?
It's either they believe God knows, they believe some crazy ass politician knows, they believe some preacher knows, they believe some market prognosticator knows, they believe some.
They think I know. I'm telling you.
They believe Dylan Radigan knows.
When I was hosting, I got to tell this story. I was hosting Fast Money. It was like sort of the financial crisis was like, it was like whatever it was between September and November of 2008. Like it was a real super mess. And I was in a bakery on a weekend, and I'm in the bakery. I was with my girlfriend at the time, who was a big football fan. She was big football fan from Tennessee Titans. She liked the Tennessee Titans. Okay.
Who the hell likes the Tennessee Titans? Okay,
so girls from Nashville. Okay, that's who. Okay.
Okay.
And so I was with a girl from Nashville. She liked the Titans. It was fun. I went to a Titans game. It was entertaining. Anyway, beside the point. At the bakery, and I look across, like he's like sitting like off. I'm at like ordering the coffee or whatever the thing is, and I look over, and as sure as you're sure of anything, John Madden, 20 feet away, sitting there with his buddies,
okay,
having a coffee and a bagel, just like a person.
Yeah.
In his butt, and I'm like elbowing April, because I shouldn't say her, but I'm elbowing her. I'm saying, look over there. He goes, John Madden. The guy with John Madden is elbowing John Madden, pointing at me. Comes up to me, he says, "Are you Dylan Radigan from Fast Money?" Which to me was a preposterous, like it was laughable. I mean, I'm like, sure, like I'll be a Mickey Mouse for you, okay? He's like, well, would you like to meet, Mr. Madden? I was like, of course, So go over and sit, I don't think I even sat, we just shook his hand. And he had been watching Fast Money like religiously, and there was something. And my point is, he thought that I knew. Like he was no different than any other scared person.
Of course,
he was sure he was going to lose all his money. I'm like, John, you must have made so much money from that video game alone. Like, forget the commentary. Like, I grew up playing Madden football. Like, how can you? Like, who cares? Sure that I knew. I guarantee. I know people are sure you know. I know I have friends of mine that they're like, ask Tom Sosnoff what he'll know. I'm like, I don't think Tom knows.
I do.
But that's not my point. My point is,
I do
how
know.
can people still think someone knows?
Yeah, I agree.
I mean, you built a whole business. You've made a fortune for your customers, you created thousands of, or hundreds of, probably thousands of jobs. You do weekly seminars, sold out, and your whole thing is no one knows. And you prove you're like, no one knows, no one knows, no one knows. You got your little birthday game, you got your pot odds, you're like, listen, take a shot, take a shot. You're gonna lose. But if but you don't know, and still you tell me everybody thinks that they know or somebody knows.
Yeah, because Dylan, we only, unfortunately, we only touch, our reach is, I mean, look, we're a tiny little boutique firm in the middle of, the Midwest, and we have a reach of, let's say, a few million people total out of billions of people. I mean, we're a pimple, on
because I think they call it a flea on a dog's ass.
A flea on a dog's ass. Okay, that's what we are.
That's the most condescending characterization.
Right, but so yeah, we touch a lot of people, and there's a lot of people that, one of the most important things that we've done for a certain group of people is obviously, give them the ability to articulate a lot of things about finance, but it's also to understand one of the most complex things about finance, which is that you essentially can only control, you can only control what you can only control what you know, and that beyond that, like, it's all on you. Like, let's stop blaming, like expecting somebody else to do something when they can't possibly know what's going to happen next is almost like another definition, just a different definition of insanity. So being able to accept the responsibility for what's going to happen next with your finances is like the coolest thing that we've done. We basically put the onus on you, Dylan Radigan, on myself, on the next person, and said, listen, this is 100% on you. Every decision you make, everything that you can control, that's on you. Why would you ever give up control to somebody else that knows less than you? And that's it. And
because they believe that they know, and the answer is because they think the guys and gals in Greenwich know more.
Well, yeah, because they have a big house in New Canaan. I mean, it's where the customers' yachts.
And they're buying the same Apple stock you can buy, and the same Nvidia, and the same Tesla, and the same Visa.
Where are the yachts? Where are the customer yachts? Getting right back to the 1940s, and where are the customer yachts? They're your yachts. There's your house in New Canaan, but where's the customer yachts? I got it.
I know you got it, but I find it marvelous that you think that it's unchanged.
I don't think it's unchanged. I think we've obviously had helped to make a dent. It's a small dent, which hopefully, for generations to come, the team that's here and will continue to expand will carry the torch, to the next generation, and this thing will blow up at some point. And then, 50 years from now, they'll say, hey, there was this guy with long hair, and he was, he talked about this 50 years ago. It'll be cool. But
it was like Pablo Picasso with money.
Yeah, exactly. My
partner, my friend in Italy, who's the big Italian art dealer, you met him briefly. He came to the speech at the end of the speech in London.
Okay.
And after he met you, he's like, are you sure that guy's a bank executive? I said, yeah, no, he's one of the most successful finance and trading executives in American history. He said he looks like a painter.
Hey, that's a compliment. I usually get worse than that.
He intended it as a catch. That was when I was pressing you. I was trying to get you promoted to guru and move you to a Greek island at that point. But it put you in a robe, wait for you to say smart things.
I usually get he just looks homeless. That's okay.
No, he looks like a painter philosopher. I'm going somewhere because there's a book called Factfulness that the editor of Luckbox magazine, Jeff Joseph, suggested that I read. And it basically talks about all these quizzes. He's like a college professor who does quizzes with people, but not just like for the most educated, whoever the world is, I don't know, the elite of London, the Cambridge Institute, or somebody in whatever, like smart people, whatever it is. And he asked them a bunch of questions about, what are the percentage of women that have an education in the world's poorest countries, or what percentage of the countries have this, and like all these sort of questions. And what he discovered was that a monkey has a much better chance of getting the questions right than a person, because people have an internal bias that gives them a set of beliefs that steers them to actually choose the wrong answer, that they're worse than randomness. I wonder if that same phenomenon is true here. I suppose it is.
Well, I mean, hence the reason that, the only reason we survived as a, market maker for so long is that we were the ultimate contrarians. When you're the counterparty, you're just doing the opposite of what anybody else is doing, and you're just doing it blindly.
And because people over-select for the wrong answer,
of course.
It works.
I mean, would the casinos, like the way to test this is, would the casinos still make money if they eliminated the VIG?
I would say yes, based on the conversation.
Of course, they would make a lot of money.
People over-select for wrong decisions.
Of course.
They either bet up at the wrong time.
Of course, they would make a lot of money. They would just make less money than they make today.
Yeah. And so no matter how perfect Tom and Tasty Trade do at quote, educating the world, until you change the structure of the human brain, which is impossible,
it's never going to happen.
It'll always over-select for the wrong thing.
Especially when there's a single movie playing that's only two-sided. There's only two choices. Not even possible that will ever change. And the rest of the world's so far behind where we are, it's never going to change. The opportunities that we face, the difference is, and I'll tell you without getting into too much detail, because this is the coolest stuff that we're working on right now. But the difference is that the market structure will change. So what's going to happen in the long run is that, you will have the opportunity between decentralization and between modern market structure, which I believe will change in the next decade. You're going to have the opportunity to be on either side, so that will change the dynamics. It won't be 100% peer-to-peer, but instead of you having to go to an exchange to do something, you might come to me to do something, or vice versa. And because of that, the odds then will change, because you will decide to do something based on the sheer fact that I want to do the other thing.
Which will basically create a third way.
Yes, which to me will truly democratize all markets and will increase efficiency like multiple times, and it will be an absolute game changer, which will benefit the strategists more than anything else. The only winner in everything that we do long term is going to be the strategist, because over time fees come down, markets get more efficient, more money chases returns, and the only people that win are strategists.
When you say strategist, you mean trading strategy, meaning
it could be trading strategy, but it could also be understanding, like divergence between, different market centers, divergence between price. It's not pure ARB, but it's just price divergence and things like that. I mean, just understanding, all the different things that are out there that are efficient is incredibly valuable to opportunity.
Speaking of diversions, I was looking this morning at some different financial diversions, specifically the Nasdaq 100 and the S&P relative to a bond index that I can't remember the ticker for, which doesn't make me hugely useful right now.
Mm-hmm. Okay.
But it was some bonding. It was showing a huge gap.
It's pretty big right now. The difference between
what's the bond index in that chart that I was looking?
I don't know which one you were looking at, but bonds are making, they're pretty much on a multi-year low right now. So interest rates are on a multi-year high.
And so the theory is either bonds have to come up or the Nasdaq and the S&P's got to come down based on the basis historically. Do you subscribe to that belief?
Well, generally speaking, interest rates and equities are inversely correlated. So sure, generally speaking, for the last decade, it hasn't necessarily been the case. But, usually, stocks go down, bonds go up, and stocks go up, bonds go down. So, I mean, there's been a certain aspect of that this year, that they've been inversely correlated this year, but they've gone to a pretty interesting extreme.
How interesting? I mean, are you trading it with any more? Like, are you more interested? Like, what's your degree of interest?
Pretty high right now. We have a fairly large, position in bonds. I'm long bonds right here, meaning I'm expecting interest rates to go a little bit lower, but our bigger position is in the yield curve. We're expecting it to steepen. So Yeah, we have a pretty big bond play on right now. Not a traditional bond play like most people would think. Like we're just not just buying treasuries or that kind of stuff. We're just hoping rates go a little bit lower, bond prices go a little bit higher, and hoping that the yield curve steepens, which you're kind of hoping that obviously long-term rates go up faster than short-term rates. So I'm playing against it's kind of almost an arb position.
But I'm not hearing any short NASDAQ or S&P in there.
I'm short the NASDAQ small, and I'm long the Russell. So that's our biggest S&P position is long Russell, short NASDAQ. It has not worked.
The NASDAQ's come off a touch the last couple weeks.
The NASDAQ has come off a touch, but so has the Russell. So on a relative basis, it hasn't really done anything as a spread.
You sound more enthusiastic for your bond sort of yield steepening. Sounds like the one emotionally anyway that you've got the most sort of.
I'm enthusiastic because there's a lot of interest in markets right here, and I think we're going to get into a really, I think the market in the first half of the year kind of blew its brains out, and in the second half of the year it's going to be very choppy and cyclical, and I think it's going to be good two-sided trade. So I'm excited about that.
Mm-hmm. I want to ask you, I won't spend a lot of time here because I know it's a miserable, place, but I just feel like I have to address it. If you had to make a prediction on the future of the residential real estate market in the face of the rates being where they are, and obviously where we are now is just it's a frozen market to the degree to which no one's selling, to the degree to which no one feels compelled to sell or can avoid selling, they are not selling in order to avoid price discovery at a lower price point. I guess the simplest way to ask the question is how on earth can house prices not come down, considering all of the pressure?
Well, there's no question in my mind. There's absolutely no question that there's. I'm actually. I shouldn't. Let me start off this way. I'm really surprised how strong the residential housing market is. The commercial housing market is very weak right now, incredibly weak all over. And yet the inner cities in America, which kind of, listen, you can say whatever you want about, farmland and rural America, but the inner cities of America power this country. And they create all the tax revenue is in the inner cities. And the inner cities are strong. And the real estate markets in these cities are crazy strong. The amount of inventory is, there's nothing out there.
I know.
And housing prices have remained strong. Rentals have remained strong. New York City, Chicago, I mean, they're all at record highs as far as, housing prices go. Miami, Dallas, same thing, right. I mean, they're all record highs as far as prices go, as far as rentals go, everything else. And so the question is definitely a valid.
I want to say, what the F? I mean, the mortgage rates, I mean, come on, what are we doing here?
Mortgage rates have the potential to get, 7-8%, and or they're closing in on 8%, which is obviously crazy high considering they were at 3%. And I think a lot of people are just, they're, unless they can do a deal for cash, they're really reluctant to borrow money at what they perceive to be very high rates. And the other side, then the other side to it is hard to borrow money. Builders have a hard time borrowing money right now. So it's been challenging for them, to raise the capital, and lot prices and land, everything's so expensive right now that the model doesn't really work. So prices haven't come down at all. Do I think that market's going to crash? For some crazy,
I'm not even saying crash. I'm just saying adjust ships, even ladder down. I mean, it's not doing anything.
For some crazy reason, it's so damn strong. And I look at different cities like Chicago, which there's nothing. Like there used to be for sale signs around. There's nothing on the market. Like L.A., there's nothing trades. Friggin' nothing trades. Nothing trades. And it's just nuts. And, and I don't follow New York as much anymore, but I'm sure it's the same thing there. So I'm inclined to think it's not a crazy speculative market like it was when like condo.com type of thing or Las Vegas boom stuff. This is this market, you know what it reminds me of? It reminds me of Bitcoin. It reminds me of digital assets. The reason Bitcoin doesn't go down and ETH doesn't go down is because nobody sells. Because there's no trading anymore. So nobody sells. It's a hard asset and they're holding on to it. And the reason real estate doesn't go down is because nobody sells anymore. There's no scalping game. There's no, listen, I'm a liquidity freak. And thank God the markets will always be these crazy liquid vehicles. But in like digital assets and real estate, there's no urgency to sell. There's no sellers. Everybody's comfortable and the prices have stabilized. Volatility is crazy low in real estate. Crazy low.
Know. That's why it's not the perfect tasty trade conversation because it's not tradable. But I mean, a couple of things. I did read one right through that was saying, oh, well, they were sort of observing some version of what we're describing here in terms of the price stability, lack of volatility, lack of transactions, blah, blah, blah. And their argument was it's great for the home builders because there's always going to be demand for new homes. Existing homes are simply not being put on the market. The only play that's left is I don't remember all the names of the new home builders now, but it used to be like whatever KBI or something or DH.
KBH.
Remember this? I'm dating myself. That's got to be 15 years ago.
No, KBH and Lennar and XHB. There's just a bunch. Yeah.
Anyway, that was the only argument that this I don't even know who wrote this up, but somebody was saying because of this sort of logjam. And because of the seller strike, basically, that the new home builders have to take up the inventory.
Well, the advantage of new home builders is, first of all, they got some big investments from people like Buffett. They've also got really strong comps to work on from banks for loans. And the banks have gotten in trouble. Obviously, the banks have realized something. I think regional banks and big banks have realized something that which blows my mind because they were too stupid to realize this all along. But there is far less risk in a diversified portfolio of small loans than there is in a concentrated portfolio of all commercial loans. The game plan with
commercial.
Yeah, the game plan with banks has, especially big banks, but even regional banks, has always been let's get big deals done because commercial real estate,
Michigan Avenue.
Commercial real estate has no risk. There'll always be somebody to lease it. There's not any risk. We don't have to worry about this. There's no default risk. All this other stuff. What it turns out is the best marketplace for real estate loans was the smaller, residential, mid-price residential, where you have very little risk. It's diversified over thousands of different occurrences. It's the same thing as Tasty methodology, diversified over 1,000 occurrences with a really diversified base. With don't forget, we have one of the strongest economies we've ever had. And so there's no defaults. So you've got this crazy strong economy. You've got people with plenty of work, so people have jobs. They're able to pay their mortgages, and you've got a diversified portfolio with almost no defaults. And the only thing you're losing money on from a commercial bank standpoint is you're getting killed on some of the defaults on the big commercial loans. That's it. So that's why. Speaking of which, but that's why the residential marketplace has stayed so strong because it's easy to get financing now.
Are the banks in the weeds? Because there was another rating agency, I didn't see which one.
It was Fitch. It was Fitch again.
Fitch came out after because Moody's, I think, was the first one.
Yeah, it was Fitch.
Now Fitch is in there saying things.
Yeah, but now they're saying things like, the same old stuff. They're worried about, commercial loans they're worried about, big commercial loans. And, of course, as Fitch starts to say that, I'm sure the market will turn the other way. I think the commercial real estate market's going to come back because companies are going to have to. The issue companies are going to have right now is they're going to have to find productivity, and because they've already reduced staff. So if you've reduced staff and you need productivity, you have to bring people back to work, because you can increase productivity by by 20, 25, 30, 35% by bringing people back to work. So as soon as they start bringing people back to work, which has already happened in a big way in the Midwest, and it's starting to happen now at other places around the country and around the world, I think you'll see a complete turnaround in commercial real estate.
Do you include New York and San Francisco in that prediction, which I think are probably the two most devastated at the moment?
I mean,
relative, San Francisco being vastly more than New York, but
San Francisco being more than New York. I mean, we were in San Francisco last weekend, not in San Francisco. We were in Palo Alto, but we were
big difference. Sir.
I understand, but it was pretty much booming, more so than I thought it would be.
But that's not the city. I was in both Palo Alto and in San Francisco 6 months ago.
Yeah,
different planets. Where the valley, for sure, boom, super boom. The city, anyway. San Francisco is neither here nor there. The point is, you think commercial that the marginal edge in productivity the next 3 years will be related to re-officification.
Yeah, I mean, I think so. If you could increase productivity by 20% by bringing people back to the office, then essentially, your bottom line goes way up with no additional expense. I just don't see how companies are going to avoid it.
But do you mean to the point where you actually think that that's a benefit to the banks? The point is, you're saying
I think it's a free call. I think it's a free call for the banks. I don't mind. I mean, personally, I don't really own any banks right now at all, but I wouldn't mind it.
Meaning, if I was to say, hey, here's some calls on JP Morgan or Wells Fargo, Tom, you'd hold them.
Well, I would never hold anything on Wells Fargo. I have committed to
that's a moral issue. I don't mean to bring up. That's
I will never own Wells Fargo as long as I live.
Goldman Sachs. I'll give you some Goldman Sachs calls for free.
It wouldn't be my first choice, but sure, I think
keep them.
I think they're going to be okay.
The first thing you'd sell. Wouldn't be the first thing you'd sell.
I think they're going to be okay. I don't lose any sleep at night worrying about Goldman.
I don't know. I mean, we're hearing stories. They're saying, Goldman, they made the misadventure into retail and mid market, and
I mean, listen, they tried some stuff. They had to try, So Goldman loses a few $1 billion. Give me, please,
Cry me a river.
Yeah, cry me a river. I mean, listen, if we have to start worrying about Goldman Sachs, we got way bigger problems. way bigger problems.
Should we be worried about America? There's an article that Josh Fabian sent us, our producer here on Truth or Skepticism.
Yeah.
That was making the argument that America has benefited from financialization and technology, whatever those two things mean, but that it's come at the cost of sort of basic human morals and niceness.
There's no question that America used to have a huge edge over the rest of the world in niceness. Niceness was our, except take New York out of the equation, and niceness was one of the greatest things about America. You'd walk down the streets.
Especially in the Midwest, I would say that was the core brand in the Midwest.
I mean, you'd walk down the streets in Russia or different places around the world, and people would, even in parts of Europe, and people don't smile, they don't say hi, nothing. It's kind of a very cold place. I mean, when they get to know you, everybody's incredibly warm, but just as strangers, it's weird. But in America, they'll tell you your life story by just saying hi, and especially in the Midwest. I think that the political polarization of this country, this is, I'm not just bashing Trump here, but Trumpism went a long way to destroying the niceness of America. Just miserable, mean people in positions. He made it okay to be a miserable, mean prick. And that went a long way to destroying, the some of the goodness of America. I'm not going to get overly political, but that's just my take.
Well, because I was thinking about it, and I was like, okay, because the media is incentivized to over-represent, the same way we over-select for the wrong decision. The media is incentivized to over-select for the worst information. We all know this, right? Yep. It bleeds, it leads. At the storm, whatever. We all know that. I think America, and really every country generally, including, by the way, New York City, which is a vastly friendlier place than people ever have given it credit for. And I know that despite your insult against New York a few minutes ago here on this program, that I do know that you, in fact, are familiar with New York City and know that we are very nice people. And it's one of the nicest cities in the world, actually, is New York City. But my point is, I don't think America's even gotten meaner. I think that there's a perception of an enhanced, I think that people perceive it. I think if you ask people, it's sort of like, I'll just give you an example of myself. I'm from both upstate New York, and then my family is from New York City. I'm a New Yorker, New York City, Long Island, the Adirondacks. I'm from New York, okay? I'll take a tour of the state. I'll take you to Albany.
I got you. I hear. Yeah.
I'm from New York.
Okay.
I hate Boston, Massachusetts, and people from Boston. Okay. I don't like them. I don't like their license plates. I don't like the way they drive. I don't like anything about them. But if you were to ask me who are some of my best friends and who are the people that I most like working with and that I've been friends with the longest, a disproportionate percentage of them are from Boston.
What's your point?
My point is, you think that you don't like something, you think that America's mean, but if you say, oh, is America mean? Or say, oh, America's mean, Trump this or whatever, Republicans, Democrats, woke, everybody is a man's a woman, there's all these things that people talk about. You're like, what are you talking about? But then you're like, okay, of the average 10 people that you interact with in your life, in your town, in your day today, anywhere, I don't care if it's in Phoenix or in Seattle or in rural Montana, anywhere, 97 out of 100 interactions are going to be either neutral or positive. So again, there's the perception.
I agree with you. Everybody's nice. Most people are honest. Everybody's nice. But there's
like if I asked Tom about his day, and I'm like, okay, Tom, when you got gas today, or when you went to the deli, or when people came to whatever the thing, order a tuna sandwich. Yeah, you're like, everybody's pretty nice. Like, no problem, right? But then I say, how do you feel about America? You're like, oh, America's getting mean, it's getting nasty. But like, where? Only on television, only on the internet, like never in reality. I guess it's my point is, it's like everybody's like, I say I hate people from Boston, but then they're like, where are all your friends from? I'm like, oh, they're from Boston. Like, it's the same. It's America's got mental problems.
All I was just going to say is, like, if you go to like Louisville, Kentucky, everybody's crazy nice. If you go to super nice. If you go to Nashville, Tennessee, like everybody's crazy nice. Like if you go to Dallas, Texas, everybody's crazy nice. But they're nice in New York City. If you go and because I sometimes get more adjusted. I spend some time in Russia. I spend some time in. I'll be like more socially introverted when I'm just walking, like I'll just fly off the jet lag. I just landed in New York, whatever. And I'll have people in New York City, in Tribeca or Soho or the Upper West Side, and they'll say, good morning, hello, stranger on the street, like Louisville style, okay? And I know it's happened to you. I know it has. No, when I go down the street, people cross the street and go to the other side. No, when you go down the street, they ask you if they're like, "Oh, can you paint my picture? Are you a portrait artist? They walk. Are you a Central Park painter?" They walk to the other side of the street so they can avoid me. Right, we're off the rails. All right, but a quick summary for those playing along at home. Tom's most enthusiastic about that bond curve steepening, which may or may not mean it's going to happen. If you're a contrarian, you might want to be a flattener, betting on the flattening. Long the Russell, short the NASDAQ. Real estate, inexplicable. Banks, a free call. And it's only mean because they're telling you it's mean, but it's not really mean. And that's your official summary of this week's Truth or Skepticism. I'm Tom Sosnoff. He's Dylan Radigan. This is Truth or Skepticism. Dylan, we'll see you next week. Looking forward, sir. All right. Talk to you soon. Bye. Bye.